Let's go. Perfect. So welcome everybody to the Cash Flow Empire Tuesday call. So we have tonight an amazing speaker. His name is Scott Hendrix. Is the last name pronounced right?
Exactly. Just like Jimmy is, I always say, for those rock and roll fans.
That's awesome. So we're really excited to talk about a really interesting topic, right? The 1031. And as you guys know, Scott is an expert in that field. So Scott, so welcome to the Tuesday call. So you want to tell us a little bit about your background, who you are, and how do you get involved in your role as
A-
Rainer?
Absolutely. I'd be happy to. Thank you and good evening, everyone. My name is Scott Hendrix, and I am the founder and the principal advisor with my firm, Current Investments Wealth Management. That firm primarily is involved with, we are primarily involved with management of securities portfolios. So we do a lot of management of retirement accounts, brokerage accounts, stocks, bonds, mutual funds, daily traded, primarily liquid securities. About 6 or 7 years ago, I was looking for a niche, a way to differentiate my firm, since obviously wealth managers, financial advisors, whatever term we go by, are a pretty populated field. So I saw that a lot of my existing clients were real estate investors, and I wanted to be a better service and a resource to them. So I branched out into a sort of a niche specialty in passive real estate investments. So these are SEC registered real estate trusts and real estate credit funds, interval funds that offer some liquidity to investors, but are all primarily backed by hard real estate assets and provide passive cash flow. That is, you're not the landlord, you don't have to do any of the work, but investors still receive the passive distributions or cash flow from these investments. There are a wide variety of them for both accredited and non-accredited investors. And I am open to questions during the presentation. If I use a term that someone is not familiar with, you can either drop it into the chat stream and I'll try to answer it, or you can raise your hand. But I'm sure most of you are familiar with some of the basic terminology. Also, I developed a knowledge base and an expertise in the 1031 exchange. So I imagine most of you have heard of the 1031 exchange. I'll go into more about what it is, but I've always thought of it to be, among real estate investors, a widely known transaction, but truly not a deeply understood transaction. And to give you an example, more investors who begin a 1031 exchange fail somewhere along the way. Their exchange falls apart either because they couldn't make it happen on the right timeline, or they simply couldn't find a property to facilitate the exchange, then actually succeed. So this was an opportunity for me to provide education. I've been doing seminars like this since back before COVID to groups of real estate investors, attorneys, CPAs, title companies, real estate agents, etc., to help better understand all that goes into the 1031 exchange. So let me jump right into it and tell you that when you hear the term 1031 exchange, what it's referring to is simply a section of the Internal Revenue Code. It's a transaction that's overseen and monitored by the IRS. So it really is all about the tax implications of selling and buying real estate. And the 1031 exchange, which has been around for over 100 years, not many people know that, but it's been in the tax code since the 1920s, was intended to create some liquidity in the exchange and buying and selling of real estate, so that every time a real estate investor wants to sell some of their property, they don't necessarily have to stop and write a big check to the IRS. So the 1031 exchange facilitates the tax-deferred exchange of one property for another, or multiple properties for multiple properties. So with that, I'm going to see if I can share my screen.
Yes, sir.
And bring
We're
up
ready to
a
go.
presentation. And I guess I'm going to rely on you, Jonathan, to let me know if you can see my presentation.
You are fine. You have a
Is
plain
it coming
time,
through okay?
Oh, yes.
Yeah, and I don't
Perfect.
know, you may have to toggle your Zoom box a little bit to see most of it, but I'll go through the highlights and hit most of the primary points of the 1031 exchange. So again, just a little background on me. My business is located primarily in Austin, Texas, where I live. I do have clients in a few other states, California, Tennessee, Washington, Wyoming, etc. I am licensed with the FINRA, which is an offshoot of the Securities and Exchange Commission. My primary office is in Austin. The information that I'm going to share with you is simply for educational purposes, and I will provide my contact information at the end. So again, I've already spoken to some of this. The Section 1031 has been in the Internal Revenue Code for about a little over 100 years, 102 years. It simply states in plain language, no gain or loss shall be recognized on the exchange of property held for the productive use in a trade or business or for investment, if such property is exchanged solely for the property of like kind, which is to be held for productive use in trade or business for investment. Now, let me say that in even plainer language. The 1031 applies to either investment or business real estate. That is a property, a physical piece of real estate that has been held for investment purposes. Either it's been cash flowing or it's appreciated in value over time, or property, real estate associated with a commercial business, a shop, a warehouse, a barn, what have you. The term like kind, I'll actually get into that in a minute. So I'm gonna not address that right at this moment. Let me move on. So here's the primary reason why investors would consider a 1031 exchange. If they own investment property and have maybe for some time, and it's gone up in value, they're sitting on property that has appreciated, and if they were to sell it outright, that is just sell it and take the cash, they would owe capital gains tax. There's a federal capital gains tax rate of 15% or 20%. The 20% rate kicks in for taxpayers in the top tax bracket. For all other taxpayers, it's a 15% tax on the portion of the sale that represents the growth in the investment, the gain on the investment. But if you declare that you're going to do a 1031 exchange, you can defer or put off paying that tax. The 1031 also covers the depreciation recapture, which applies if you have taken depreciation, that is reduced the value due to wear and tear over time. That's a cash flow benefit each year you take it, but when you sell the property, there's a tax known as depreciation recapture. Sometimes it's called clawback. And that is 25% of the amount of the depreciation that you've taken. So that becomes a tax due unless you do a 1031 exchange. If you're in the top tax bracket, there's a Medicare surcharge of 3.8%. That can also be deferred. And in some cases, if you're in a state that charges a state capital gains tax, that in some limited cases can also be deferred. So you can potentially defer quite a bit of obligation that would otherwise go to the IRS, keep it invested in your own growing real estate portfolio under Section 1031. It allows you to potentially diversify your real estate holdings, keep more of your own money invested in your own real estate instead of paying the government. And there are no limits to the number of times you can do a 1031 exchange over a lifetime. You can do one every time you have appreciated real estate that you wish to sell. I will pause for a moment and just remind everybody, I am not a CPA, nor am I an attorney. It's always a good idea when you are contemplating any kind of complex real estate transaction to have a CPA or an attorney look at the details and advise you accordingly. A 1031 is possible when you own investment or business real estate and wish to sell it, take your gains, but reinvest the proceeds in other business or investment real estate. As long as you can accomplish everything within the rules of the 1031 exchange, you're likely to save yourself, at least to put off, a big tax bill. All right, let me see.
Let's see. Actually,
Yeah,
if you guys,
go
if you
ahead,
guys have any
Jonathan.
questions, if you guys have any questions, like for example, Santos right now,
Yeah.
feel free to just raise your hand. So we will bring these questions right here to Scott. So,
Thank
but
you,
let's go really
Jonathan.
quick. Let's go, Santos. Welcome.
Hey, good afternoon. Good afternoon, everybody. How are you?
Awesome, man. Glad to have you here,
Okay,
man.
so the 1031 exchange, my concern with that is if you have several properties and you have, like in my case, I have owned a lot of single family homes, and every time I do a flip, or like right now, I just sold a multifamily building. When do I pay the taxes? Eventually, all the taxes that I'm deferring is going to catch up with me, and at the end, I don't want my kids to be able to pay all those taxes for me. If I pass away, I don't want my kids to have to face a big tax bill. So when I can defer all the property's taxes, but eventually it's going to catch up with me, right?
Well, the short answer is not necessarily. For one thing, you mentioned one word, and I do address this in a little bit, but you mentioned flipping. I will say that the IRS does not consider real estate acquired for the purpose of flipping to be investment real estate. In other words, if you buy a house, fix it up, and then put it on the market to sell it, that is typically what happens in a flip. The IRS will not consider that transaction eligible for 1031 exchange. The reason is they consider real estate bought for the purpose of flipping to be inventory and not investment. The key term is held for investment. So if you buy a house and fix it up, you're going to want to rent it out for a year, sometimes 2 years, in order to pass the IRS threshold to be considered held for investment. So that's probably one of the most common questions is, can a home flipper do a 1031? The simple answer is no. But the other part of your question, you can continue to do 1031 exchanges on property that you have held for investment. And then if the original owner passes away and they have heirs, the heirs benefit from what is called the step up in cost basis. All of the previous accumulated deferred taxes go away, because at the point of death of the original owner, the cost basis of all of the real estate is reset to the market value as of the time of the original owners passing away. So the heirs could inherit that real estate with no deferred tax liability. If they continue to hold it and it continues to go up in value, then yes, they're building up a brand new appreciated value. But the previous owner's deferred liability is wiped off the books upon that owner's death. So the 1031 exchange really does work well for investors who are seeking to leave a legacy or an estate of real estate for their heirs.
That was a good answer.
Now, if you do, let's say over the rest of your life, you do 3 1031 exchanges, and then when you reach age 80, you decide, you know what, I'm going to sell and cash out. If you're still living and you decide to do that, then yes, all that deferred tax liability does come due. It's cumulative. So that would potentially put you in a big tax liability situation if you decided to cash out while you're still alive. Now, I know some people who've done that. They simply want to go ahead and bite the bullet, pay the tax, and enjoy, freeing themselves of all their real estate investments. But typically, the 1031 is ideal for investors who know that they want to leave it in their will to the next generation, who will not have to bear that accumulated tax liability.
Good.
Okay. Did I answer your question, Santos?
Yes, sir.
Awesome.
Yes, sir. I appreciate that.
Awesome. Good question, Santos. Good question. So let's go. Keep going, Scott.
You might have froze up for a second there, Jonathan. I'm going to press on. Okay.
You're good.
All right. Okay. All right. So
I got a question if that's all right.
Yeah. Who was there?
what was that?
Who was there? Who was there?
The question is, if you miss your 45-day window to locate your property, or you don't close in the 180 days, is there any other way you can defer to kind of like save yourself and defer the taxes, or that's it, you're done for?
There is currently another way that I am aware of, and that is called, you can invest the proceeds in an opportunity zone. If you've heard of opportunity zone investments,
No.
that is another way to defer taxes on real estate. However, I'm not prepared to speak on that topic this evening.
Okay.
I do have clients who do that, and I'd be happy, Jason, if you want to reach out to me with some questions, I'd be happy to speak with you one-on-one. But tonight I'm going to talk about the 1031 exchange.
Awesome.
Okay. All right. So instead of going through these words, I'm going to go straight in. Yeah. I'm going to go straight into the illustration. So here are the basic steps of a 1031 exchange. So you've got property. You're ready. It's gone up in value. You're ready to sell it. You think you've got an interested buyer. So you go through the process of setting up the sale. The very first thing you want to do, if you're going to do a 1031 exchange, you need to reach out and hire a person who performs the role known as
Is it just me?
No, he froze.
He froze, right? Okay.
Yeah, we lost
Good.
him for a second.
That's good. Should be coming back. I see his name still here, but so are you guys having fun or what?
one of the key fundamentals of 1031 exchange is the investor can never handle the money. The money from your sale has to go directly into the care and safekeeping of a qualified intermediary who acts as a neutral third party and holds your money for you during the entire exchange. So it is critical that you interview and retain the services of one of these professionals before you close on the sale of your property. I do not perform that role, but I do refer clients and potential clients to many of the qualified intermediaries that I know and work with. It's critical that this take place before the initial closing to kick off the process. Once you have hired the intermediary, they'll give you some paperwork, including what you will ultimately file with the IRS to declare your intent to execute a 1031 exchange. This also must be disclosed in the sales contract that you negotiate with the buyer of your property. Then you go to closing. You've already hired the QI or qualified intermediary. They have opened a bank account to receive the proceeds from your sale. The title company at closing transmits those funds directly to that bank account so that the investor does not take possession of those funds. Then when you close, and I think the gentleman referred to it, once you close, you start a 45-day clock. You've got the first 45 days of your 1031 exchange. Excuse me, I don't know if y'all hear that phone ringing. Let me shut that off. You've got 45 days to identify a property or multiple properties that you would like to try to acquire or buy, reinvest in with the money that you made from selling the previous property. And it is critical. This is one of the hard and fast rules of 1031 exchange. You can't take 46 days. If you have not successfully identified the property that you, or multiple properties that you wish to buy by the first 45 days, your deal collapses, you owe the tax, and your money comes back to you. So that first 45 days is critical. You can identify, under most normal circumstances, up to 3 properties. You don't have to buy all 3. You can identify 3 or 2 and really only attempt to close on 1. The other 2 might simply serve as a backup in case something goes wrong and you're unable to close on your primary property that you wish to buy. So the rules do allow you to identify more than 1 property. Once your 45 days are over and you've identified the property you wish to buy, then you've got a remaining 135 days to close. So the 1031 exchange is defined as a 180-day process from close to close. It starts with the close of the property you sell. It is completed with the closing of the properties that you, or single or multiple properties that you wish to buy. Now, you don't have to take the full 180 days. You can close sooner, but you cannot close after 180 days. If it takes you longer than that, your deal fails and you owe the taxes that you were originally trying to defer. So pretty strict and tight timelines. The IRS does count weekends. They do count holidays. So if Christmas falls in the middle of your 1031 exchange, that counts as a day. The IRS does not recognize days off or holidays.
Love it, love it. Awesome.
And then as you move in on closing on the property you wish to buy, you do need to disclose to the seller of the property that you're trying to buy, you do need to disclose in the purchase agreement that you are coming into the deal via 1031 exchange. It's just simply full disclosure. And then hopefully you successfully close on the sale, on the purchase of your replacement property, and the qualified intermediary, that person you hired back before the start, that person transmits the funds to the title company at closing, and the deed is handed over to you, the investor. Then you've got a 1-page form that you need to file with the IRS, and that's due by the next tax filing deadline. Okay. Maybe I should pause here and see, Jonathan, are there any other questions?
We have a question about Alex. So I know
bet.
that I wanted to kind of let you go through that, presentation first, right? But Alex, so welcome to the call, and amen.
No, thank you so much for having me on the call. Scott, that was a great presentation so far. I just kind of have two questions. One, how much does it cost to set this up? And two, can you utilize maybe like a trust to solve all these things, like a specialized, maybe a spendthrift trust or something? Like, what are your thoughts about that? And what is the setup structure for something like that?
Yeah. So great question, Alex. The cost primarily is what you're going to pay that qualified intermediary, and their fees are pretty nominal. Typically I see a qualified intermediary is going to charge you between $750 and $1,000 up front to help you fill out the paperwork and open that bank account. And then at the end of the process, they're going to charge you about the same amount, $750 to $1,000, to complete the deal and to close on the properties you're buying. So you're looking at probably somewhere between $1,000 to $2,000 for the upfront cost of hiring the qualified intermediary. Now, your other question was about trusts and those kinds of things. I'll be very honest with you. That really depends on the particulars of your situation, and I'd be happy to visit with you offline and talk about some of those details. But rather than try to address all the different kinds of trusts or alternatives that one might use, I'm going to stick with the simple example of an individual investor selling property and then buying another property through a 1031 exchange. Is that fair?
That sounds great. And I would definitely love to visit offline because I love your information and just want to look at all the alternatives, to do so.
Absolutely. Yeah.
And,
like I said, my contact information will be at the end, and I'm happy to visit with any of you offline or one-on-one, in the future.
Sounds good. Thanks so much.
Awesome. Great,
Okay.
great question, Alex. We have another question from Irma. Irma,
Yep.
welcome to the call.
Hello there. So I've done a few 1031 exchanges on for myself, but it's been a while. But can't
Yeah.
you start to designate a property even as soon as you go into contract on the property you're trying to sell? As long you can, if you found one, you could designate it before it closes, right?
Well, yes, that is true. And I always advise people, the earlier you start,
Yeah,
the better off you're generally going to be.
yeah,
So if you have a pretty good idea of what property you want to go after, once you sell your property, you're always at an advantage.
yeah,
You don't, in other words, it's not like, it's blind. Once you close and your 45-day clock starts, only then can you start looking. By no means. You can always do your scouting anytime. And in fact, it's generally an advantage. If you have a pretty good idea of what property you want to target before you even start the 1031 exchange, so that as soon as you close on the property that you're selling, you can notify your intermediary right away. Hey, I want to go after this one, and this one. And you've already done your homework and you think the seller's, motivated or whatever. And you're gonna save yourself a little grief when it comes time to hit those deadlines.
yeah. I mean, for me, that was like, I was too afraid to miss the date. So I was like, already like, I'm in a luck right now,
Yeah.
to try to find something.
Sometimes to a real estate agent or to a CPA or even to an investor, sometimes 45 days can go by really fast and be, cause for a little bit of panic or a little bit of stress. So it's always a good idea to start early.
And are you gonna talk about like properties and that?
Yes.
Okay, all
Yes.
right. Thank you.
Okay.
All right, bye.
Awesome.
I want to address
Good
right
question.
now the topic of debt replacement. Or Jonathan, is that okay?
Of course, keep
Ready
going,
to
man.
roll?
I'm having a lot of
Okay.
fun, keep
All
going.
right, good. So debt replacement. This sometimes can be a little bit of a confusing topic. I'll try to make it real basic. In a 1031 exchange, you're looking to reinvest the entire sales proceeds from the property that you sell not just the profit, but the entire sales proceeds. Now, 1031 rules require that if the property you're selling still has a mortgage, still has some debt on it, you've got to replace the value of that debt in whatever property you acquire. So I'll give you a simple example. If you sell a property for $1 million, but you've still got a $200,000 unpaid debt to pay off, you sell that property for $1 million, 200, the $1 million goes to the qualified intermediary, the 200,000 goes to the bank to pay off the note. You now need to find $1 million worth of property to buy. You can't just buy property with the remaining 800,000. You've got to replace the value of the debt that was on the property that you sold, either by taking out a new loan, in other words, borrowing, in my example, another 200,000 to find a $1 million property or a combination of properties for $1 million, or you can bring new cash into the deal to the tune of 200,000. So you could use your 800,000, but you've got to, go to your bank and bring another 200,000 into the deal so that you successfully acquire $1 million or more. You can always go over, but you can't be under the total sales proceeds from your original real estate. So debt replacement sometimes is confusing, but that's in the simplest terms. If you sell a property that has a mortgage on it, you've got to acquire a property that either has the same or greater mortgage on it, or you've got to bring cash into the deal in the amount of or greater than what the mortgage or the debt was on the previous property. Okay. Some terms, just what we were talking about with the term like kind. The 1031 exchange is sometimes called the like kind exchange. That can really be confusing because a lot of people think that what that means is if you sell an apartment building, you have to buy another apartment building. Or if you sell self-storage, you have to buy another, industrial or self-storage property. That is not true. All the IRS requires is that if it's physical real estate, you got to buy some other physical real estate. You can sell raw land and buy a structure. You can sell single family and buy multi. You can sell mineral rights, that is underground oil rights, and buy self-storage as an example. So don't be too confused by the term like kind. We're really simply talking about any kind of real property can be sold, and any other kind, including the same kind of real property, can be acquired under 1031. So just a couple little illustrations and we'll move on. Assets that are not like kind, I've already addressed this a little bit. Inventory does not equal real estate. So as an example, if you're a flipper, you're not eligible, that property is not eligible to be sold and have the proceeds reinvested under 1031. Also, if you have a business and you have a warehouse, you can sell the warehouse, but you cannot sell the farm equipment or the actual products that are part of your business under 1031. Only the actual physical real estate can be sold under this tax deferral technique. Okay, I've talked about the qualified intermediary. Think of that as a neutral third party who acts in good faith, and of course you sign a legal agreement with them to hold your money while you conduct this transaction. A reverse exchange is rare. I'm going to skip that topic for now. I've mentioned some of these terms already. An accredited investor is someone who has income of 200,000 a year for the past couple of years, or 300,000 if they are married, or they have liquid assets of 1 million or more. Now that can also be real estate, but it must exclude the value of your primary residence. You must have a net worth of 1 million or more in order to be considered an accredited investor. However, you do not have to be accredited to do a 1031 exchange. You do, however, have to be accredited to access certain kinds of passive real estate that is 1031 exchange eligible, and I'll speak more on that in just a moment. Any leftover cash at the end of the deal, which is commonly called boot, that is, if you, back to my example, if you sell your $1 million property and you pay off the 200,000 loan, and you only acquire 800,000 worth of real estate, that extra 200,000 is going to be taxed. So you won't truly complete a full 1031 exchange because you're going to get taxed on whatever cash is left over at the end of the deal uninvested.
Awesome. I think that we have a question right here, Yoshi.
Yeah, sure.
You wanna unmute
Okay.
yourself?
Hi, Scott. So actually, one of our people in the chat has a question. Her name is Leah. She asks, is it the original debt or the remaining debt amount?
I'm sorry, can you repeat that?
Yes, it says, is it the original debt or the remaining debt amounts when you're doing a 1031 exchange?
It's whatever debt was still on the property at the time you sold it. So it's the remaining, or yeah, it's the remaining debt.
Okay, awesome. Thank you for clarifying that.
Yes.
Thank you.
Okay. All right, I'll go on. So again, a couple of simple illustrations. If an investor sells a property for $1 million and they originally acquired it for, let's say, 300,000, they're looking at a $700,000 gain, which they would owe all those taxes on unless they did a 1031 exchange. So the first step is they hire the intermediary who takes possession of their full 1 million in sales proceeds. Then they identify a property or two that they wish to buy. One of them is an office property for $750,000, and the other one might be a multifamily in a type of real estate called a DST. I'm going to come back to that in a moment, but they might put the remaining $250,000 into a different type of real estate. So $750,000 and $250,000, they have reinvested their full 1 million in proceeds, and they've completed a successful 1031 exchange. Side-by-side comparison of this example, if they did not do a 1031 exchange, that capital gain of 700,000 in the box on the left would produce a tax liability of 140,000 just for capital gains at 20%, the Medicare surcharge of 26,600, and let's say they depreciated 100,000 over the time they owned it, they'd owe, 300,000, they'd owe 25% or 75,000 back. So they would only have 750,000 to go look for new property. However, if they do a 1031 exchange, all the same numbers apply, except they don't owe any tax. So they have the full million to reinvest, potentially keeping or saving almost $500,000 of their own money to invest in more of their own real estate. So it is a pretty powerful tax deferral opportunity for investors. Just a couple of comments on expenses. Normal transactional expenses can be paid out of 1031 funds. So if you owe a broker or you owe an attorney, or you have an agent that's looking for your properties for you and you owe them something, the qualified intermediary fee I spoke about earlier, inspections, etc., all of those typical real estate costs can be paid for out of the 1031 exchange money. However, you can't do things like, prorate the rent, buy down points, pay for utilities, or buy mortgage insurance using the 1031 exchange funds. I'm going to skip this. This was for when I spoke with a group of oil and gas investors. I mentioned earlier a type of ownership called a DST. That stands for Delaware Statutory Trust. This is an option that is only available to accredited investors. So if you meet the threshold of an accredited investor, you have potentially an additional option in your 1031 exchange, and that is to reinvest in passive real estate. So I use the term passive to simply mean real estate that you own as a fractional interest, but you have no hands-on responsibility for managing or maintaining the property. You are simply receiving the passive cash flow as a partial investor in a Delaware statutory trust. It's a very unique option available to accredited investors that allow them to basically convert from being an active landlord or owner of property to completely passive ownership, where all they have to worry about is, are the checks going to the right bank account? Okay, just a few more details about a DST. I won't go into the details here, but that is a unique option that I broker for my clients. More details about the Delaware Statutory Trust. Again, if any of you do have questions on this particular topic, I'd be happy to visit with you one-on-one. I'll just point to 3 reasons why an accredited investor might consider it. One is simply to identify it as a backup property. Going back to your 45-day identification period, if you know you want to buy, let's say, that apartment building in your town, but you're not 100% certain that you're going to get a deal and going to be able to close on it, if you're an accredited investor, you can name a Delaware statutory trust property as simply as a fallback, so that if you can't close on your primary objective, your money can roll into the Delaware trust. You have completed your 1031. You own now a fractional interest in a passive real estate, and you're receiving the cash flow. So they work great as a backup property. If you ultimately don't need the backup property, doesn't cost you a thing. The Delaware Statutory Trust simply goes off the books if you're able to acquire your primary identified property. They also make a great way to capture that leftover cash that I referred to, called boot. So let's say you sell your $1 million worth of real estate, and the property that you buy is $900,000. You almost can't buy anything, at least not around Austin, for $100,000. So what are you going to do with that small amount of leftover cash? Well, you can buy a fractional interest, if you're an accredited investor, in a Delaware statutory trust. So they make a great way to kind of find a parking place for the small amounts of leftover cash, if there are any, in a 1031 exchange. And then the third reason that you might see, excuse me, I got a little ahead of myself, is with a case where an investor simply is tired of being a landlord and they want to get out of all their active real estate and go 100% passive, but they don't want to pay the IRS. So they may go completely into DST type ownership and simply get the cash flow coming to their mailbox or bank account every month. A few more reasons. I'll skip over those in the interest of time. Some of the limitations, I'll skip over that for now. And this graphic may be a little out of date. I think it was more having to do with my oil and gas clients. So I'm gonna blow through this one. And I think we're nearing the end. Some of the common mistakes I'll address that happen in my experience in 1031s. The qualified intermediary, which is crucial to have on board. However, they can't be somebody that you have a pre-existing business relationship with. So it can't be your attorney, or it can't be your CPA. It truly has to be a completely third party You have to have an arm's length relationship with them. That is only for the purposes of this deal. Do you retain their services? And again, I do offer referrals to a variety of qualified intermediaries to my clients. The property must qualify as investment property. I've already spoken about this. Generally, that means from the IRS standpoint, it has to be held for, the rule of thumb is about 2 years. It has to be held, doesn't have to be cash flowing, simply has to be owned for about 2 years in order for the IRS to consider it an investment property. I'll skip the part about cash out refinance. I think I'm going to go ahead and go to the end because we're coming up on 10 minutes to go. And here is my contact information. Actually, my email, let me put in the chat my email. This
Please.
charts are a little out of date. But my phone number is correct. My email, my business email is scott@currentinvestments.net. Please use that one if you'd like to correspond with me via email. Also, by all means, feel free to visit my website, which is simply currentinvestments.net. That's current like the flow of water, investments plural.net.
Awesome.
And I would be happy to visit with any of you who have detailed or unique circumstances that you'd like to discuss. I don't charge anything for consultation on 1031 exchange. And I'd be happy to take any questions, Jonathan.
Yeah, that is awesome. And thank you, Scott, man. That was a really amazing conversation today. It was a lot of things that I was not aware of, right? So how powerful this tool can be, right? For you to save money and just coming back to your point, have more money to reinvest. So this is powerful. This is powerful. So let's give a little bit more, like a couple minutes to see if you have any questions right here for Scott. So if you don't have questions, so you got already the Scott information in the chat. Joshi also, she posted again his information. So if you guys don't have any questions, but please reach out to Scott, right? Because having somebody like him in your team, as in your pocket, right, for future, because if you are not ready now, you don't have a property that you are thinking in selling, probably you will have that in the future. So having somebody that's Scott in your pocket is important for you and your investments, right? So let's give a couple more minutes, but I have a question for you, Scott, really quick. So
yes,
so this is powerful, man. I see that I can just sell my single family and then invest in a syndication, right? In a multifamily, right?
that's correct. Now, one thing I didn't mention, you can't do a 1031 with your primary residence. This only applies to investment or business property. So in other words, you can't sell your home and do a 1031 exchange.
Interesting.
But yes, if you own a single family investment, you can sell it and do a 1031, but you're not limited to buying another single family. You could buy multifamily, you could buy, as I said, you could buy anything, a commercial office, self-storage, raw land, any other type of investment real estate.
Awesome. Love it. Love it. Okay. We have a question from Lydia. Welcome, Lydia. And just go ahead and ask your question.
Thank you. I have a couple of questions. One is, you mentioned that you have to use the whole amount of the purchase, but then you mentioned the boot, the amount left over. So if you do a 1031, you set everything up, and then at the end, you don't reinvest the whole amount. Is that okay?
As long as you
I was just not too clear on that.
Well, as long as you do a partial 1031, in other words, as long as all of your money originally went to the intermediary, but you're simply not able to close on properties to equal that full amount. No, but you've maybe invested, I don't know, half or 3/4 of it. if there is cash left over at the end of your exchange, that amount of cash will be taxed proportionately at the capital gains and other tax rates just for that remaining amount of cash.
Oh, okay, perfect.
As,
That
you know,
clarifies. So
again,
you
as
have
long
to
as you,
transfer the whole amount first.
yeah,
And
the
then if,
whole,
okay.
right. But because here's an exception. If you sell $1 million of property and you send that million to the intermediary, but then let's say a week later, you say, you know what? I need 100,000 of my money just to go do something else with. And you call the intermediary and say, hey, could you go ahead and just send me cash of 100,000? That's going to kill your whole deal. Because not only have you not really even begun the process, but you've demonstrated that you haven't turned over control of your money. You still exercise control by requesting that some of it come back to you prematurely. And if you do that, you're going to owe tax on the full amount of your transaction, not just the remaining leftover amount.
Okay, got it. Perfect. That
Yeah.
does clarify. And my second question is, I own a home, my husband and I own a home in California. That was our primary home, and we lived there for 3 years, and we moved to Florida last year. And California has that, maybe other states too, that if you're filing jointly, you have 500,000 that you can be excluded from capital gains if you lived in the house for 2 years or more. So I'm not sure if you're familiar with that, but I was just wondering, we did live in the house for 3 years and we moved and we are renting it out now as long-term. So we're using as an investment home now. Are we still safely qualified for that? And or should we consider the 1031 exchange to avoid capital gains tax?
Yeah. So two answers. From the national tax standpoint, in other words, from the IRS standpoint, as long as you have not lived in the house for the last 2 years or more, and it is not your primary residence and has not been for 2 years or more, from the IRS standpoint, you can sell it and do a 1031 exchange. Now, California is always a little tricky because some of their real estate tax laws come back to get you, so to speak. And that is where I do not have specific expertise, but I do know California has the highest state capital gains tax in the country. And they are also what's considered a non-conforming state, meaning that their state capital gains tax will come due when you finally sell that property, even if you're doing a 1031 exchange under the federal tax rules. So I can't speak to the homestead exemption or whatever it's called in California, that $500,000 set aside. I can't speak to that. I don't know how California treats that, but I do know that they have a state capital gains rate that generally will be due, even if you declare a 1031 for the sale of your California property.
Okay.
But the federal capital gains rate can be deferred.
Okay. Yeah.
Or excuse me.
Okay.
Yeah, the federal tax can be deferred. The state tax may still be an obligation.
Yeah. Okay. Thank you. Yeah, we're hoping that we can still get that, you know, the deduction on the capital gains. We're thinking about selling it and reinvesting somewhere else. So
Yeah.
I'll just look into more into that in more details.
Now, I will say that one of the qualified intermediary firms that I refer clients to is a nationwide firm. They have representatives in many states. They would very likely have that state-specific expertise if you wanted to reach out to them and consult on that specific California question.
Yeah, that'd be great if you could share the contact.
Yeah, so reach out to me afterwards and I could put you in touch.
Okay, great. Thank you.
Love it, love it. Thank you. That was a great question, Ligia. We have Santos. Let's go, Santos.
Yes. Try to follow up with the question that she was asking about when you do a like when you do a sale. So let's say your proceeds are 200,000, and even before you sell the property, you say, "Hey, I want to use $100,000 to go do whatever," and then the other 100,000, I'm going to do 1031 exchange on that.
No,
you cannot do that.
That's an ineligible situation.
Okay, because in the past I was told that
What'd you say?
can do that as long as you tell them before the other process is done.
If the proceeds you get for the sale of your property are 200,000, that full 200,000 has to be set aside with the intermediary to begin your exchange. You can't take 100,000 out and say, I only want to 1031 the other remaining amount. That kind of transaction will be declared ineligible by the IRS.
Okay. Thank you.
Sure. Now, it's also important to remember that it's really important to do the math. And I have a spreadsheet I use with a lot of clients to kind of run the numbers for them and hopefully advise them on whether or not a 1031 is even going to be in their interest to do. Because you really need to look at what your gain is on the property that you're selling. And the gain is going to be the difference between what you originally paid for it minus any depreciation plus any improvements. That whole amount subtracted from what you sell it for, that difference is going to be your gain. And you're only taxed on the gain. So it's important to kind of calculate what that number is, apply those tax rates, determine the value of the taxes that you're going to defer, and then decide whether it's worth it to you to do a 1031 exchange versus just go ahead and sell it outright, pay the tax, and move on.
Okay, that's awesome. We have a Joshi.
Hi, so we have a question in the chat.
Okay.
1 second. Felipe del Valle asks, what happens to the passive investors when the property is sold?
So I'm going to assume that you're asking about the passive replacement property called the Delaware Statutory Trust that I spoke briefly about. You can do another 1031 exchange. So if you're an investor, if you came in to a DST, which is passive real estate to you, if you came into it with 1031 money, when the property in the trust is sold, you will receive notification in plenty of time to set up another 1031 exchange if you want to. So it acts just like any other piece of real estate, except it's passive. And which means the investor does not have control over when the underlying property may sell. But when it does sell, they can take their share of their investment plus any gains they may have realized and simply kick off another 1031 exchange.
Okay, perfect. Thank you.
Yeah.
Okay, Ligia, welcome again.
Yeah, sorry, just
You're good.
another question that came up on the leftover amount. So, and it kind of tags in somebody else's question too. So let's say, you do decide to do the 1031 and then, but you have to have the 3 properties or, that you're looking to investing. So does those properties, do they have to have the same or a higher amount of your, you know, the 1031 exchange, the 1030 exchange that you have to apply, or not? Or is
Yeah.
that does the IRS look into that? Because I mean, if you're gonna have, I'm just saying, like, let's say, you know, somebody's think, oh yeah, I'm gonna try this, but then if I have some amount left over, I'll, of course you pay the tax on that amount, but do the properties have to have the same amount or higher when you're selecting them for the 1031 exchange?
I can answer that by saying definitively, that's a good idea. With the 1031 exchange, all of the specific guidelines and regs are not written out. It really comes down to, in the judgment of the auditor or in the judgment of the IRS, did the taxpayer make a good faith effort to do a 1031 exchange? One of the ways you demonstrate a good faith effort is by naming or identifying properties that equal or exceed the value of the property you're selling. It's going to look, frankly, it's going to look kind of suspicious if you sell $1 million and only identify, you know, 750, knowing that there's 250 that's going to be unaccounted for. That might be a red flag to the IRS that you never really intended to reinvest that amount. And they're probably going to invalidate the entire deal. So yes, it's always a good idea to name properties that exceed or equal the value of whatever it is you sold. And, you know, make a good, you know, and again, you don't have to invest in all of them. If you can name one or two of them as a backup. But if, and in that case, if there is cash left over, simply because you were unable to buy the properties that you identified, that's not so much a red flag. That's where the IRS is probably going to say, okay, that's legitimate, taxable, remaining cash. You're going to only owe tax on that portion of your transaction, not the entire amount. But if you start out by kind of lowballing what you want to buy, that's probably going to trigger a red flag. And they'll, again, what I've seen is they will very likely invalidate the entire deal.
Okay. Yeah, I mean, I'm not, I don't even have one right now to do that, but I'm just, that came up. And also, you could be looking at properties the same amount or more, but then you are able to negotiate the value down, and then you
Right.
have some left over.
That's again, I think that would be considered, you know, good faith, you know, good for you. You saved a little money, but you're going to owe tax on that
Yeah.
amount of money that you save. Yeah.
Interesting.
Okay. Thank you.
Awesome.
Yeah.
Okay. Do you have another, do you have some time for one final question, Scott?
I'm good. Yeah.
All
I'm
right.
good.
Awesome. Let's go, Jimmy. My friend Jimmy from Seattle.
Thank you, Jonathan. Hi, Scott. Thanks for the amazing presentation. So
Sure.
one question I have is for those who want to invest in syndication and private fund, and they just, for this scenario, they just sold their property, right? So I think you skipped this when we're talking about the reverse 1031. I would like to know, how would that work?
So yeah, I get this question a lot. And are you asking if the investor is either coming out of or going into a syndication, how would it work?
Correct. And then they recently already sold it, right? Because the 1031 is when you identify the property and then you sell the property. But then for this case, they already sold the property.
Yeah.
Now they have this period of time, they go back to 1031. How would that work?
Yeah. Well, if they have already sold a property and taken possession of the money, they cannot decide they then want to go do a 1031. They've already missed that first critical step, which is don't take possession of the money, send it to a neutral third party to hold it for you. So you pretty much have to know that you're going to do a 1031 before you sell.
Mm.
Now, real quick, in a reverse exchange, you can buy a property that you wish to own before you sell the property that you want to sell and use the proceeds to replace, let's say, the loan you took out to buy the new property. I don't want to go down that path right now because it is complicated, but that is basically how a reverse 1031 exchange might begin. The other question, or the other, as I interpreted it, a question you had about syndications. The tricky part with syndications is that the IRS requires that the tax ID number of the owner who sells the property to begin the exchange has to be the same tax ID number on the property once it is acquired. So if you're an individual and you own a property as your social security number, you know, there's not an LLC, you simply own it as an individual, you can go invest the proceeds in a syndication, but the syndicator, the general partner or the syndication, has to allow you to own your fraction of that syndication as a separate individual owner social security number. You can't become part of an LLC if that LLC has a separate taxpayer ID number. So usually with syndications, you're going to want to have a real estate attorney to help determine the complexities of, you know, what taxpayer ID number owns the property that's being sold, and can the structure be arranged in such a way that the same tax ID number owns the interest in the new property. But again, happy to talk more in more detail one-on-one.
Powerful answer. Did he answer your question, Jimmy, right?
Yes, thank you so much, Scott.
Awesome.
Sure.
Okay. So thank you guys for joining tonight. So I know that Scott, you're a little busy, so we appreciate you being here. And for you guys that stay until the end, remember that we have our breakout rooms. So I don't know if you, Scott, have another 5 minutes to go in like in a room with 3 or 4 people, 5 people.
You bet.
And you guys can ask a little bit more private questions. So, but then thank you so much, Scott, for being here. And thank you, everybody. Also, it was a lot of fun tonight. And we will see you next Tuesday.